Before we begin, this video is for educational purposes only and is not financial advice. Always do your own research before making any investment decisions. Right now, as you watch this video, inflation is quietly stealing your money. Not through theft. Not through scams. Through something far more subtle, and far more dangerous because most people never even notice it happening. In this video I'm going to show you exactly how inflation erodes your wealth, why keeping money in a savings account is costing you more than you think, and the simple strategies you can use to protect and grow your money faster than inflation can destroy it. Let's get into it. Inflation is the gradual increase in the price of goods and services over time. When inflation is running at 3% per year, it means that on average things cost 3% more than they did a year ago. Your groceries, your rent, your energy bills, your coffee. Everything gets a little more expensive every single year. This doesn't sound catastrophic. 3% per year feels manageable. But the compounding effect of inflation over time is genuinely shocking. Here's a simple example. Imagine you have 10,000 euros in cash today. You put it in a drawer and leave it there for 20 years. With 3% annual inflation, after 20 years that 10,000 euros has the purchasing power of only around 5,500 euros in today's money. You didn't spend a single cent. You didn't lose anything on paper. But inflation quietly ate away nearly half the real value of your money while it sat there doing nothing. This is what makes inflation so dangerous. It's invisible. Your bank statement still says 10,000 euros. But what that 10,000 euros can actually buy has shrunk dramatically. Most people's instinct when they want to be responsible with money is to put it in a savings account. And while a savings account is absolutely the right place for your emergency fund, relying on it for long-term wealth building is a serious mistake, and here's why. Savings account interest rates in Germany and across Europe have historically been very low, often below 1% per year or even close to zero. Even in periods of higher rates like recently, savings account rates have typically lagged behind inflation. Let's put this in concrete numbers. If inflation is running at 3% and your savings account pays 1.5% interest, your real return is negative 1.5% per year. You're earning interest, yes. But inflation is outpacing that interest. In real terms, in terms of actual purchasing power, your money is shrinking every single year even though your balance is growing. Over 20 or 30 years this gap between savings account returns and inflation compounds into a massive destruction of wealth. This is exactly why simply saving money in a bank account, while safe and necessary for short-term goals, is not a long-term wealth building strategy. To actually grow your wealth you need your money to grow faster than inflation. And there is one asset class that has consistently done this over long periods of time better than almost anything else. The asset class that has historically beaten inflation most consistently over the long term is equities, stocks. And the simplest, most accessible way for a beginner to invest in stocks is through ETFs. Here's the logic. When inflation rises, companies typically raise their prices to maintain profit margins. Higher prices mean higher revenues. Higher revenues mean higher profits. Higher profits mean higher stock prices. So stocks, and the ETFs that hold them, naturally tend to rise with inflation over time. The numbers back this up dramatically. The S&P 500 has returned an average of roughly 10% per year before inflation since 1957. With average inflation of around 3% per year over that period, the real return, after inflation, has been approximately 7% per year. That means a global stock ETF has historically grown your purchasing power by around 7% every year on average, not just keeping up with inflation but significantly outpacing it. Compare that to cash in a savings account which has historically earned close to 0% in real terms, or even negative real returns, and the case for ETF investing as an inflation hedge becomes overwhelming. This is why we talk about ETFs so much at SimpleWealth. It's not just about growing your money. It's about protecting your money from the silent wealth destroyer that is inflation. ETFs are the primary recommendation for most beginners, but let's quickly cover the other assets that have historically beaten inflation, and some that haven't. Real estate has historically been one of the strongest inflation hedges. Property values and rental income tend to rise with inflation. The problem for most beginners is the barrier to entry. Buying property requires significant capital, involves high transaction costs, and isn't easily diversified. Real estate investment trusts, called REITs, allow you to invest in property through the stock market without buying physical property, and many ETFs include REITs automatically. Gold has a reputation as an inflation hedge, and over very long periods it has maintained purchasing power reasonably well. However, gold produces no income, no dividends, and has long periods of underperformance. For most beginners, it's not a priority. Bonds, which we'll cover in a future video, are generally poor inflation hedges because their fixed interest payments lose real value as inflation rises. This is why bonds struggled so dramatically during the high inflation period of 2021 to 2023. Cryptocurrencies are sometimes promoted as inflation hedges, but their extreme volatility makes them unreliable for this purpose. Bitcoin dropping 70% in a bear market is not hedging inflation, it's speculation. For most beginners, the conclusion is clear. A broad global ETF, MSCI World or S&P 500, is the most practical, accessible, and historically proven way to protect your money from inflation while growing your wealth simultaneously. Here's your simple 3-step action plan to stop inflation stealing your money starting today. Step 1. Keep only your emergency fund in cash. 3 to 6 months of essential expenses in a high-yield savings account, a Tagesgeldkonto in Germany. Enough to cover emergencies. Not a single euro more sitting idle in cash long term. Step 2. Invest everything above your emergency fund into a broad global ETF. Either the iShares Core MSCI World ETF or the Vanguard FTSE All World ETF. Set up a monthly savings plan on Trade Republic or Scalable Capital. Automate it. Let it run. Step 3. Increase your monthly contribution over time. Every pay rise, every bonus, every reduction in expenses, funnel it into your ETF savings plan. The more you invest and the longer you invest it, the more dramatically you outpace inflation and build real long-term wealth. That's it. 3 steps. No complexity. No exotic investments. Just a clear, simple system that puts the power of long-term equity returns to work against the silent wealth destroyer of inflation. Inflation is real, it's ongoing, and it's affecting every euro you own right now. But it's not unstoppable. A savings account slowly loses to inflation. A broad global ETF has historically beaten it by a wide margin year after year for decades. The choice between the two is one of the most important financial decisions you can make, and now you know exactly which one to choose. Subscribe to SimpleWealth for more simple investing content every single week. Drop your questions in the comments and we'll see you in the next one.